Welcome to ForexTV.com's PM Exchange. It's Thursday, December 13th. I'm Remy Hokie. Today I'm joined by Joseph Trevisani, Chief Market Analyst at FX Solutions. Good afternoon, Joseph.
How are you, Remy? Nice to see you.
Thanks for coming on the show today.
As always.
Well, in today's session, we started out the morning with some data on inflation as well as U.S. retail sales, and we saw the U.S. dollar gain against the euro, sterling, CAD, as well as Swissy. But I'd like to touch on the inflation data we got out. PPI surged 3.2% for the month of November. If you could tell us what this means for the upcoming Fed rate outlook and also about rising energy costs.
Well, you know, the PPI is always interesting. The Fed doesn't target it, and no one who really targets or discusses inflation really discusses PPI very much. The issue with PPI is the carry through to consumer price inflation. It's not as strong as it used to be, and there's a certain amount of debate as how much influence it actually ends up having. With worldwide competition, many firms have lost their pricing power that they had formerly. So even a strong PPI as we had, and this was very strong, I mean 3.2 is a lot, doesn't necessarily mean that it transfers over into CPI. Plus, this was the base rate. This was the headline rate. It was not the core rate. Now, from a consumer point of view, you can certainly make the point that, well, you still have to pay those prices, and you do. But energy prices being as volatile as they are, it is not a core rate, which was only at 2% for the year.
Okay. Well, Joseph, you mentioned the consumer, and we also had U.S. retail sales for the month of November come out today, and they came out higher than expected at 1.2%, and that follows an unrevised 0.2% September increase.
Right.
So if you could shed light on the retail sales data and also the CPI, which comes out tomorrow morning.
Well, let me do the CPI first because we just spoke about PPI. I think the CPI probably will be probably a little bit worse than expected. Right now they're looking at 0.6 as an expected for the headline, and I believe 0.2 for the core. I wouldn't be surprised if you get it a bit stronger than that. But as far as the Fed policy goes, I don't think it makes a lot of difference. The Fed has already made their growth inflation decision. They made it back in September. When they started cutting rates on the 18th, that was the decision. They knew very well that there was a good chance that we were getting increased inflation in the future, primarily attached to energy prices, but nonetheless, they knew of that. They've already done that. For the consumer, which, let's back up a little bit, all of the predictions, many of which you're seeing now for a great decline in GDP in the fourth and the first quarter next year, are based through a decline in consumer spending. Consumers are supposedly going to be halted and crimped in their spending by decline in housing markets, by inflation, by energy prices. Without that actual number, which we haven't seen yet, except for today, the sum of the strength of the scenario for a declining and slowing U.S. economy loses its force. We have the first indication, as we've had in the past, when scenarios have been based on a consumer who refuses to spend. We're seeing some of that diminish again now. If the consumer doesn't stop spending, if the economy keeps expanding, then the predictions are obviously going to be a bit faulty, and we have a new scenario.
Okay, Joseph. Well, while we're still on the topic of the Federal Reserve, we had many events come out from the Fed Reserve this week, including the rate cut for the discount rate as well as the Fed funds rate. And the market was disappointed by the 25 basis point rate cut, but in the following day, we got the announcement from the Fed that they'll be injecting liquidity along with 4 other central banks. So now that we have all the central bank meetings out of the way, as well as today's SMB, if you could give us your take on rate differentials as they stand now. Sure.
You know, when the market's worried, it likes to be surprised, but it likes to be surprised in the direction that it finds beneficial to its own needs. The market fully expected a 25% cut. It got it, but I suppose it had residual hopes that it would get a half a point or something would happen in the discount rate. It didn't get it, obviously. The interesting factor was the discount rate. At the time, many people were saying, well, why didn't they do this? If they really want to get people to go to the Fed for liquidity to help the markets, to help the credit markets, why didn't they cut the discount rate or remove the penalty? They had to wait the next day for the answer. The answer is quite obvious in their auction facility that they're setting up. One of the reasons they probably didn't announce them at the same time was they give 2:15 at 2:15 London's closed. And this particular facility involves central banks in Europe, the ECB, the BOE, and the SNB. So they might have delayed for that reason. Whether it actually has an effect, I think it probably will. One of the ways that, when you look at the way the Fed supplies liquidity is through open market operations. Open market operations work through money center banks. They doesn't necessarily by right filter down to many of the other banks which may be having problems, smaller banks, which may be having problems with credit access. This does directly address that particular problem. But it, of course, leaves it to the banks to decide whether to use it or not. It is very much a market solution, which I think is interesting. We'll see how the banks deal with it. I think they probably will avail themselves of it enough to alleviate a lot of the problems.
Okay, Joseph. Well, now that we've highlighted the fundamentals that are weighing on the majors, let's take a look at dollar action against the majors. The U.S. dollar got a boost on the heels of today's data this morning. But at the New York close, we saw the euro regain a little bit of strength against the yen, as well as the U.S. dollar. But as we head into year-end, we're going to be seeing a holiday thin trade. If you could give us your short-term outlook for your dollar. Sure.
You know, I think I've been here many times, and you know that I've been a dollar bull for about 6 weeks now, thinking at the end of the year and other things that the move against the dollar has been very much overplayed. Tomorrow's the 14th. As far as liquidity goes, many of the major banks start restricting their operations in the FX markets starting on the 14th. Many of their customers do as well. So we've had fairly normal liquidity up till now. The last 2 weeks of the year, you will see a great diminishment in liquidity. That usually means much more volatile moves, stops are often executed, and the tenor of the market is much more unreliable in that it doesn't really reflect the wider market. It often reflects one or two large players. Given that, when you combine the two factors that we had today with the PPI, we're going to have CPI tomorrow. It's probably going to be stronger, or at least as strong as expected, which is already fairly high, and stronger retail sales. You take out two of the major legs that have been supporting the euro and assumptions about the euro. One, that the American economy is going to decline. We don't see signs of it yet. We're still waiting. And two, that will cause the Fed to continue to lower rates. Well, we've now had a point since September 18th. That's 2 months we've had a full percentage point of reductions. That's quite a bit. We know the future will work in 6 months. That's the horizon for that. When you take that with the increased inflation, the Fed's worries about inflation, which they've said many times, the market likes to discount what it doesn't want to hear. It doesn't want to hear rates on hold. Talking the equities markets. It wants to hear reductions. So you combine that with a strong number in retail sales, you have two props out of the euro. So I, as you know, look for a strengthened dollar towards the end of the year.
Okay, well, while we're talking about the dollar right now, as well as equities, in today's U.S. session, the major equities closed mixed with the Dow up by around 44 points. But in dollar yen, we saw the pair hit a peak at 112.44, but traded between 112 and 112.30, but didn't break above 112.50. What do you forecast for dollar yen in the coming session?
I think probably we're going to see I would say about 111.50 to probably 113.50 by the middle of next week. I really think we're going to have an upside move here. It's going to take some time to get rolling. It's not going to be the kind of move where you have an enormous surge in either the euro or the dollar yen, even if it's dollar based. The euro yen is still going to be resilient as far as protecting the downside in both those currencies. But sooner or later, and I think sooner rather than later, you will get a breakdown in these things. The technicals are all on that side, and the fundamental props that we've been speaking about have been severely, I won't say damaged, but called into question.
Okay, and while we're talking about the broader market, I'd like to touch on the so-called commodity currencies of the Canadian dollar as well as the Aussie dollar. In today's session, we saw the U.S. dollar strengthen against the CAD, and it broke past the 102.15 level. And also looking at the Aussie against the U.S. dollar, it bounced this afternoon and is ending the U.S. session around 0.8760. And we know that commodities prices ended lower for the New York session. So if you could give us your forecast for those currencies.
You know, for those currencies, I think, you know, they're sort of acting as, to use an old cliche, the canary in the coal mine. If you're looking at a slowing economy in the United States, a large user of commodities, obviously, that you're going to see the reaction that you've already seen. And it's a reaction that goes back 3 weeks. A lot outside the market doesn't necessarily pay attention to the smaller currencies. What gets the focus in the press and in the media is, of course, what's going on with the euro, what's going on with the dollar. But when the smaller currencies move, they're trading against the dollar. Their view is a view on the dollar. So if you have reversals in those currencies, you're looking at a judgment by traders and by commodity traders that the economies in those countries will be less supported, and so will their currencies being, because you have both a returning strength to the dollar for other reasons, and also because there is going to be less demand on commodities. So you've seen that reaction already. It's only started to work its way through to the euro, because the euro has a broader base as an economy than the smaller economies of what we call the commodity currencies.
Okay, Joseph, and last but not least, I'd like to touch on the Swissy. Earlier today, the Swiss National Bank stayed on hold for interest rates, and there was a small minority of the market expecting a rate hike, but they did stay on hold, and we saw dollar Swiss touch its highest level in 5 weeks in today's session, touching 1 and 14.51. So now that we have the Swiss National Bank rate decision out of the way, what's your forecast for the other carry trade currency?
You know, I would say that as far as the Swiss goes, it's not been a favorite speculative of the Swiss franc itself. You're going to look at it towards the end of the year. I think it's going to be riding pretty along with what the dollar does. The Swiss franc, the Swiss yen, which is not really a major carry trade currency because the rates are both very low. You don't have that motivational advantage, which I've never believed that much anyway, but at least it's one which is portrayed as much. So I would say as far as the Swiss goes towards the end of the year, you're not going to have a lot of focus on it, and you will have it trailing along with the general dollar move that I expect. Of course, we'll have to see if it follows through any further than it has so far.
Okay, Joseph, as always, thank you very much for your insight.
Thank you very much, Remy. Nice to be here.
This has been New York Forex News with Joseph Trevisani, Chief Market Analyst at FX Solutions. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended mixed in another seesaw of a trading session. The Dow ended in positive territory, while the Nasdaq and S&P ended nearly flat on the day. After the focus on the latest Fed announcements, investors remain concerned about the surge in wholesale prices. PPI rose 3.2% in November for the largest monthly gain since August of 1973. Core producer prices, which exclude food and energy, rose 0.4% in November. The Commerce Department also reported that November retail sales rose 1.2%, following an unrevised 0.2% gain in September. Meanwhile, initial jobless claims fell by 7,000 for the week ended December 8th. The 4-week moving average for initial jobless claims fell 2,000. At the closing bell, the Dow Industrials advanced 44.06 to end at 13,517.96. The tech-heavy Nasdaq ended down by 2.65 points at 2,668.49, and the S&P 500 1.82 to end at 1,488.41. And in the fixed income market, U.S. Treasury prices sold off sharply on the day. The benchmark 10-year Treasury note fell with its yield at 4.17%, up from 4.09% late yesterday. The 30-year bond tumbled with the yield up 4.61%, up from 4.54% in the previous session. And the 2-year note fell with the yield at 3.16%. In energy, NYMEX crude oil futures fell over $2 on the day. After rallying nearly 5% in the previous session, there was plenty of profit taking. January crude ended down by $2.14 at $92.25 a barrel. In other petroleum products, January heating oil fell 2.85 cents to $2.6147 a gallon. January gasoline was down 3.84 cents, settling at $2.3744 a gallon. Meanwhile, natural gas futures also declined, even though the EIA reported inventories were down for a third straight week. January nat gas paired earlier gains, ending down by 22.9 cents at $7.179 per million BTU. And over in the metals complex, gold futures traded lower, below the $800 an ounce level. but futures prices ended the session at $8.04 an ounce. The precious metal came under pressure as the U.S. dollar gained against most major currencies in today's session. February gold fell $14.80, settling at $8.04 an ounce on the NYMEX. And in other metals, March silver futures tumbled down 58.80 cents on the day, ending at $14.237 an ounce. December copper fell 7.65 cents on the day, ending at $2.93.95 a pound. This afternoon, we're joined by Tom Puckett, commodity broker at KS Futures. He'll recap today's action in energy and metals and also give us a short-term outlook.
Thank you, Remy. We've had a very active trade in the last week in the metals and the energies, as well as basically across the whole board on the commodity front. We've had action in the equities, action in the currencies. The grains have taken a run of their own, and the livestock has been pressured in current trade. So, been a very busy board for the week. In the EIA report yesterday, the Energy Information Administration's report of inventories in the energy sector yesterday, came up with a crude oil decline of inventories of about 700,000 barrels, as well as a decline in distillates, that's the heating oil and diesel, of about 800,000 barrels. So little pressure there on the inventories, bolstering possibly a little higher pricing. Although today we've seen the crude actually come off a couple dollars, currently pressing down from previous highs. We opened a little below yesterday's close. We ran up, and we've run down to where we're now about in the trade about $2 or so below the close yesterday. So pretty volatile. Gasoline inventories were actually up 1.6 million barrels, where the forecasts were looking for about 1.2. So that has probably translated into some volatility in the market trade as well. The dollar has been under a little bit of pressure with the interest rate being lowered a quarter by the Fed yesterday. At the same time, the euro has been both higher and lower. So kind of a whipsaw. The current dollar trade is up about 43 points and 430 basis points, and the euro is down about 100, whereas earlier on it was just about the opposite. So the trade still is very much antithetical or reverse trade, inverse one to the other, low dollar, high euro. The current trade in the crude oil, we have a front month January in the futures around 92 and a quarter, about $2.12 down. Very definitely, we've been moving through the higher range from about 870, 875 up to the highs of 99.29, so we haven't gone back up there, but in the mid-range of that we have some interesting support lines as well as resistance. Crude oil may be getting ready for some kind of a breakout with the higher prices we've had, and the fact that it's just not good public relations for everybody to blame oil companies for high prices in crude, because they really don't set prices in crude. It, to me, looks like it might be a possible look of a decline coming in the price of crude. The natural gas has taken a little advantage of the current cool snap we've had, a little ice and snow going on, and we've rallied a little bit from lows under $7. Yet we still find that the crude, or the natural gas, is down for the day at the January contract, down about 21.5 cents, over $7, about 7.20 in that range, with the range today shown of 752.9 down to 717.6. So energy sector very active, very quick trade. In similar manner, and kind of in course with the energies as we look at today, the gold has moved south. We're at about $15 lower than we were. We opened gold again pretty strongly on the January contract. We actually ran up today, or the February contract, I should say. The February contract, we ran up to 819, and currently we're trading at 802.60 with a low today of about 797. So looks like a little profit taking going on. I still think the market is favorable to the haven value of gold and silver, a safe place to be, and I think that still remains. But we look like we're having a little profit taking. Silver likewise has traced south. We're about 57 cents on the December contract, which is front month still, and about 58.5 cents on the March. So pressure on the metals, but they still are at high levels. $14 range for silver, $800 range and above in the gold contract. Prospects for the future, it's going to relate to basically what the markets do. The Dow Jones is down slightly. The S&P is down a little bit. Not major moves, but they are a little bit pressed. a dollar stronger and the euro is weaker, these things could reverse. So volatility seems to be the name of the game, with, I think, a bias for some retracements. And I think that's what we're going to see in some of these markets, possibly more in the energy than in the metals, but I do think we're going to see some slides both sides of that table on that trade. So as we finish out the week tomorrow, it'll be an interesting chart pattern to look at. It'll be all over the place, basically. And we'll just take a look next week to see what they've done. Thank you very much, Remy.
That was Tom Puckett, commodity broker at KS Futures, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.